People are starting to say that looking back, maybe the S&P 500 bottomed on Monday, March 30th, when it hit 6316. Oh, that was the low, and lots of people are saying it's time to call the bottom right here, right now. And you know what? It's certainly possible. But what I want to do is walk you through what caused that low, so that if we're ready, if we get another big decline, right, as the war against Iran could escalate, I need you to know what to do. Notice I said if, because it's very hard to call a bottom in a market where the variables are the plans of the President Trump and who's ever running Iran today. We can certainly set the stage of what happened at the lows last week, though, so that you'll be ready, even as this now feels like a very different market today, with the Dow gaining another 165, the S&P advancing 0.44, and the Nasdaq rising 0.54%. First, you have to recognize, no matter what you heard today, that the supposed bottom last week was not caused by anything related to stocks themselves. The bottom was caused by interest rates. Specifically, on Friday, March 27th, the 10-year Treasury hit an 8-month high of 4.482, and that was really scary to people. But last Monday, rates dropped, and they dropped very hard to around 4.3%. That's a big percentage move. That happened despite the fact that oil actually went higher that day. The first time we saw the divergence in this terrible stretch. Oil up and rates down, that was the shock that caused the bottom. What happened that day to make that impossible story change? Did President Trump say something that brought the war closer to a conclusion? Did the Iranians capitulate somehow? No, nothing like that, not at all. What happened was Fed Chief Jay Powell gave a talk at Harvard on Monday, March 30th, and he took a lot of people by surprise who follow bonds at least. He said that inflation expectations are grounded, even as the energy prices rise. He said the central bank doesn't need to respond to this oil shock with higher interest rates. He said that the Fed will look beyond the short-term gyrations of the energy market. And he said that the federal funds rate, the one set by the Fed, is a, quote, good place for the Fed to sit and observe. Phew, that was a monumental call. As it was overlooked by stock traders, it meant everything to bond traders and was more than enough to stop the decline. Rates were going lower. Why? Simple. As recently as that Friday morning before the Monday talk at Harvard, traders were wagering to be better than 50% probability of a quarter percentage point rate hike. Not cut, hike. And increase, because that's what the Fed's supposed to do when costs get out of control and inflation's creeping back up while employment's steady. Kind of exactly what we have. Powell busted that thesis plain and simple. The traders were on to something very big. They knew that the Fed chief was taking a rate hike off the table, not just for last week, but for the April meeting. And then, well, that's the end of Powell. In June, Kevin Warsh will be Fed chief. He's Trump's pick. He's not a marionette. But we know that, like the president, Warsh thinks the economy needs a push. We had good employment numbers reported just Friday, right? Good Friday. Market stocks were closed. They were much better than expected. But with Powell taking the possibility of a rate hike off the table, we don't need to worry about the labor market being too strong. And that's how important Powell's comments were to bonds, to oil, and most importantly for you, to your stocks.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.